Hello and welcome back to another episode on the Property and Lending podcast. Today we have a special guest following up from last week's special guest. It's not going to be tough to follow up at all. Today we've got Bishoy Wasef, who is an accountant who's actually been on our show a couple of times in the past. So we thought we'd give him a ring back and bring him on. How are you, Bishoy?
Good, man. How are you? How's everyone? How are you guys going?
Yeah, good. You're probably the best dressed person we've had on here, to be honest.
I've seen a couple of your previous podcasts. You guys all look so fly. So I tried to step it up. I didn't know it was casual. Maybe because Origin coming up. I don't know.
Yeah.
I don't know, you guys are pretty.
It's just because usually we record a bit earlier, but because you made us record later, we all got cold and put on.
I do apologize. That was on me. I do apologize.
I was going to say we went for a run, but anyway.
Today we've got you on for a reason. We've been trying to get an accountant on for a long time, and we get asked a lot of questions. Myself, Fadi, Mark get asked a lot of questions about tax implication questions from regarding and linked to property. And obviously, we are not qualified to answer those questions, so we thought we'd get the expert on. And I know Fadi and Mark have prepared a lot of questions for you. So. We'll probably just get straight into it, but I think a lot of the questions are going to revolve around trusts and companies and different structures. Before they get into their questions, I might just ask very briefly if you can explain what is a trust? What is a trust account? How does it work? What is the benefit of a trust?
A trust is essentially a vehicle that allows you to function with certain income, whether it's investing in property, running a business, or any sort of, whether it's passive actually or trading income. And once the trust gains a profit or loss, mainly a profit, you're able to just distribute it to certain people. And what I mean by distribute, you're allowed to flush it down or stream it based on what the trust deed of that trust says. Works the same way like a will, for example. It says, well, at the end of the year, a trust shall distribute to Kyrillos, for example, or to Fadi, or to Mark. And that's what the essential backbone of what a trust is. It's a vehicle that allows you to determine and to have the discretion to flush income or flow income down to beneficiaries.
Yeah, okay. So it sort of looks like a family tree, I guess. It starts at the top and comes down. And and a trust is a separate entity to a person and a company. Is it separate or is it the same?
No, it's definitely separate. So just like a company is a separate legal entity, a trust itself is a separate legal entity. Now, a trust is unlike a company, though. A company has its shareholders and has a director. A company has a shareholder and a director. Where a trust is a bit different is there's actually no owner per se. There's a trustee who works on behalf of the trust. And then you can have that as an individual or as a separate company running through it, and which we'll run through a bit later on, the pros and cons of both a bit later on.
Yeah. Okay, beautiful. I'll let Mark and Fadi jump in with their questions. I'll jump in later.
I'll let Mark start because he's pretty excited. He's got a few.
Kick him off. Kick him off, Mark. Kick him off.
So I guess for a mortgage broker, the most commonly asked questions or the most commonly discussed things that we do before going through the application is trying to find out exactly how the customer wants to buy the property. So let's assume we have someone buying an investment property. Let's also assume it's a positively geared property. From our point of view as a broker, there's a lot of benefits in buying in a trust or company, but we're just trying to understand what's the differences in buying in a trust or company if it's positively geared as opposed to in your personal name in terms of the land tax and also the differences for capital gains tax.
It's a good question. It's actually a good question. You're kicking off right hard, like you didn't warm up to it at all. We'll go one by one. I feel it's hard to just go through all of them in the one go.
Yeah.
So we'll stick to the first part of your question, which I think was along the lines of positively geared property. And what's the benefit of having it in a trust compared to keeping your own personal name and going through like that. Now, the positive geared property allows you, let's say an individual, you get taxed in your individual name accordingly to in the individual tax bracket you're in. So if you're at the lowest tax bracket compared to the highest, it has depends on that tax rate. But if you're looking at the worst or highest case scenario, you're looking at the highest margin, which is about that 49.5%, which is 47.5 plus the 2% Medicare levy. Now, in a trust, it works in a different form. When it's a positively geared, you have to distribute that income. So what I mean by distribute it, similar to what I was touching on earlier, you have to decide who you want to allow it to go to. Now, the flexibility with a trust is you can actually pick and choose where you want it to go. That best maximizes it from a tax perspective. So obviously before 30th of June, you'll do something called trust minutes saying this is where it will go. And you'll look at each person, whether it's a company or individual situation, and see whether or not you want to distribute to them. So the pros of a trust is you can actually choose where you want it to go. Whereas in an individual's name, you have no flexibility there. If it's in your name, you got to distribute. You have to claim in your tax return. If it's 50% you or 50% someone else, your share is in your name. In a trust, you have the flexibility of choosing where you want that income to go.
Bishoy, in regards to the personal name, the income that's coming in, one of the other questions as well asked rental expenses, like for example, utilities. Can we add, like, let's say you're positively geared, but can you take out utilities out of that amount as well, since it's going towards an investment? Any repairs that need to be around the house, if anything is going wrong during the year, can you add those back as well? Is that taken out of that income?
Yeah, so with expenses, there's two forms of expenses. There's capital expenses and there's just your general deductions. So your general deductions like your council rates, your water rates, your strata, your insurance, they're all expenses that you can claim in that year, that full expense. Now, the benefit of them depends on what tax bracket you're in, but if it's positively geared, yes, you are right. It can go to reducing it from being positively geared to being negatively geared, depending on the scenario. Where it's capital items, those are items that they don't necessarily, it's not a repair, but it's an improvement. So let's say, for example, I've got an investment property and I decide to put a granny flat at the back for whatever reason to get a separate income stream. That itself is not a repair or an expense. That's a capital item which needs to be depreciated over a set period of time based on effective life. So you still get that benefit, but you don't get that benefit in that 1 year as one hit. You get it over a period of time. Same way if you have a motor vehicle, in certain times you could either you can depreciate it over a set period of time.
What if new tenants go in and the old tenants is like not ruin the house? Like you got a few repairs around the house, some renovations you need to do, need to put new paint, kitchen. Can you also, is that taken out of the positive geared income as well?
Yeah, that's correct. So
repairs?
yeah, so anything that's you got this. The main thing I'll look at when I'm looking at those invoices or when your clients are asking you is, oh, whether can I claim it or not, is it getting it back to its original state or is it improvement? So if it, similar to what you were saying earlier, if it's let's say the kitchen's been damaged to the previous tenant and you have to restore it, or you're to repair now, it's not an improvement, it's actually a repair. You're restoring it back to its original quality. In that instance, yes, you can use that to reduce the positively geared property as an expense.
Can you also claim depreciation on the new renovations as well?
Yes, you can. So with the new ones, it depends it depends on what you're doing, but overall, yes, you can. Any improvements that you do, you can depreciate it over a set period based on effective life.
So yeah, just going back, just wanted to understand with land tax. So most of the time when I tell clients, because it's positively geared and you're looking, like for example, if you have someone that's looking to buy an investment property first, this is their first ever property, and then a house that they're going to live in, there's a lot of benefits from our point of view, so they don't get capped out, that we tell them may be worthwhile exploring with your accountant if this goes into a trust or company. A lot of the time, the accountant will come back and say it shouldn't go into a trust or company because you're going to be under the land tax threshold. You're going to be, under the land tax threshold if it's in your personal name, and you probably won't pay land tax, as opposed to if it's in a trust or company, you're probably going to have to pay land tax. So what's the difference in the threshold?
So to touch on that, it's important to know what is land tax, right? Because the whole premise of a land tax is it's pretty much a tax, like most things, that applies to you who either you own it jointly or by yourself, and it's over the land value threshold, which is what you're discussing. Now, that doesn't include your main residence, so the place that you're personally living in, and it doesn't include other properties that are primary production, like farming and all that. It also depends, the threshold is, because land tax is a state-based law, it's based on the location of the property. And so you would need to go to the Office of State Revenue for that specific state to determine, which you can find on their website, to determine which state and which threshold applies to you. Now, to add on what you're saying about whether buying it, what's the difference between buying it in an individual's name or buying in a trust name? When you buy it in an individual's name and a company, most of the time, again, keep in mind, in a company, it depends, but in all the general rule of thumb is buying a property in an individual in a company name allows you to make use of what we like to call the land tax threshold. So what that is if you have a property, multiple properties, and let's say, and you got to make sure, you got to remember, it's not separate values, it's the total value of those lands. So if you have 2 properties and the total is over, we'll use New South Wales, for example, as an example. And keep in mind, it does increase year by year based on inflation. Currently, I believe, don't hold me to it, but I can check. Currently, it's about $822,000, which is the general threshold. So any assets, what I mean by is any property over that amount, that's not your primary place of residence and primary production. Any property value over that 822, other than that, I then taxed at 1.6% for anything above 822.
Okay.
So does that answer your question so far from the individual's perspective?
Yeah, and it's flat, that 1 point, whatever it was, 1.6%, was it?
Yeah, so it's $100 plus 1.6% of any value above the 822.
Right, and that's on the land value, not the property value.
That's on the land value.
Okay, perfect. Okay.
And just
Whereas
to
in
clarify, sorry, Bish, real quick, just on that, just to clarify, the total land value per state. So if I owned properties in New South Wales and Victoria and Queensland, it's not the total together, each state. It's total for that state only. Is that correct?
That's correct. So because it's a state-based law, it's based on what you own in that state.
Yeah. Sorry.
So if you have all your eggs in the one basket, then what I mean by all your investment properties in the one state, it's something you're important to look at to determine whether it's valuable for you to be doing that, because obviously that's a cost that you need to bear. Yep. This applies to both individuals and companies. General rule of thumb for companies. A trust is slightly different. Because it's similar to what I was telling you earlier, no one actually owns a trust. A trust by itself in nature is a separate entity, but it's not owned by anything. So trusts actually don't have that threshold. So you actually get taxed from the get-go in a trust. Now, there are exceptions to the rule that applies to certain trusts, specifically unit trusts. But again, I'd highly recommend going into that the Office of State Revenue specifically for that state and reading into it, because there's criteria that needs to be met for it to not have to take that, for it to get the threshold, essentially.
Yeah. So what you're saying there is in New South Wales, if you purchase the property under in a trust, there is no threshold, and you'd be paying land tax from day one.
Yeah.
Whereas under your personal name, you have an $820,000 buffer.
Yeah, that's right. $822,000 buffer. Yeah.
Okay. So with that, sort of raised another question for me. So let's say, for example, we wanted to buy in a certain structure to keep the broker happy rather than the individual name, if it's positive again, and also want to keep the accountant happy and ourselves happy by minimizing land tax. So we probably will purchase in a company rather than a trust, because like you're saying, the company also has that same threshold. Is that right?
Yeah, again, it's pros and cons. So yes, if you're applying it to land tax, you are correct. But let's say, for example, because in the company's name, it gets taxed at 25%. So any income gained, or because it's a passive entity, it could be 30%. So it depends if it's running a business or it's a general passive entity. But let's say it's a passive entity, just investing in properties, it gets taxed at 30%. So you need to look at the pros and cons from that side as well to determine whether that meets their needs. So it might solve your land tax situation, but if they've got family members that are not earning any income, or if they've got kids that are just about to turn 18 that we can potentially distribute to, there's quite a bit of benefit there in having it in a trust name as opposed to the company. So I would look at it holistically, but from a land tax perspective, yes, you are correct. you'd look at trying to do it from an individual or company, from a land tax perspective, to make use of that threshold. Or if you can potentially purchase a unit trust, a bit more complicated, but that also has its benefits, and sometimes, in rare cases, being able to make use of the threshold.
Right. And I guess one other thing with purchasing in a company is if you have someone, for example, is a high income earner, so above that 30%, the company's tax, whatever it was, they probably would want to retain the profits in the company and save on tax that way rather than paying themselves and having to pay their higher individual income tax rate. So I guess there's an advantage there as well.
Yeah, that's 100%. But the misconception that we all have is, yes, it serves the purpose, and I don't want to overcomplicate it, but it serves the purpose of obviously paying little tax now. But to take that money out of that company, because obviously individuals believe, or like if for me, for example, if I was a general person, it's my money, so I should be able to take that money out of the company. By you taking out the money out of the company to spend, it has its own disadvantages, and you might end up putting yourself in a more difficult situation later on. So yes, you are right in the sense of, from a tax perspective, early in the short term, you paid less tax, because instead of paying it at 49%, at the individuals, now you're paying it at 30%. But once you try to take that money out of the company, there is a bit of a discussion needs to be met with the client to explain to them why there could be some differences.
I've always believed purchasing in a company in an individual name is pretty much the same. Like Bish is saying, I think in regards to the tax implications, it is a little bit more different. But whether you put an individual name or a company name, if you put under a company's name, you're still going to pay yourself the same PAYG. And I think you're just more, like it's more protecting the profits of the company to be left in there instead of paying yourself more that year for tax. And again, it's going to have some sort of tax implications if you want to take that money out in the future as well.
Yeah. Look, again, and there's, again, like most things in accounting, you probably know, there's ways to resolve problems that arise. So, for example, in that situation where it is in a company, and I'll highly recommend those listening to speak to their accountant about it, because there is a cost to it. There is a way of being able to take out that money out of the company and give it to other individuals, similar to like through a trust, without having to go through the individual shareholders. It's called reissued dividend shares. But again, I would highly recommend speaking to your accountant about it, because there's a rather cost to it as well.
It's more of a case-by-case basis as well.
Yeah,
So
that's
a lot of our customers, they come through and they go, what do you reckon is going to be the best way to do it? And it's always good to say, well, you need to see your accountant, because he knows, like the tax threshold, for example, the structure of the company or the trust that's going to be put in place as well.
Yeah, 100%.
Yeah, I got a question, and we see a lot of our customers is where they run businesses or they own property, wherever it may be, from a company that is within a trust. Why is that a benefit? Why do a lot of customers, like for a lot of people that ask that question, why is that a benefit where you've got a company that's running a business, but it's within a trust? Is that more protection for the individual, or is that more protection for the company?
When you mean by a company, so do you mean that it's running a company by the shareholders of trust?
Yeah.
Is that what you mean?
Yeah. So it's held by a family trust. The company is held by that family trust. Yeah.
Yeah. So shareholder of that company is a family trust.
Yeah.
Yeah. The reason behind doing that is it does two things. Yes, one, it provides protection, because if anything was to happen, the client himself is not at the firing line. But also it provides an extra tax benefit later on, similar to what Fadi was saying earlier, and you, Mark, when you were saying, putting in a company is a lower tax rate and 30% as opposed to the margin of 49%. Well, yes, and when you have that money in the company, well, how are you going to take it out? If the individual was a shareholder, then you would have to take it out by paying a dividend to that individual. But when a trust or a family trust is the shareholder, because it's a shareholder similar to you owning shares in publicly listed companies, when the company declares a dividend, it goes to the shareholders. In this case, it's the trust. And then the trust can then flow through that to different individuals. That has the flexibility. But not only that, it actually has the franking credits attached to it. So the tax credits involved with what? Because obviously the company would have paid tax on that income at some point before it got declared. So you get that credit.
What is the definition of a franking credit? Because that's also something that we see coming up with our assessors as well. In regards to the franking credit, so what is that? Because we see that on a lot of our financial stuff like that, and it's one of the main questions that come up. And some customers even say like, we don't even know what that is.
It's a pretty much, the franking credit in a nutshell is an imputation credit or a tax that's already been paid by a company to their shareholders. So if you look at this situation right here, let's say in 2022, this company made a profit. So it was a positive year property. It paid the 30% tax, and the money is held in that company.
Yep.
And then the year after, your client wants to take that money out. Right? They're taking out the following year. So what happens is they've already paid that tax on that income. So they shouldn't have to pay that tax again. So that tax that they've paid already acts like a credit for them. So in the individual tax return, it gets added back as a credit for them. So they don't actually pay that difference. So not too complicated, but in this situation, let's say we took that money through a trust and we decide to pay it back to the individual.
Yep.
And if that individual is at the highest margin of 49%, he wouldn't pay 49% of tax on that dividend. He would pay the 49% less the 30% that the company's already paid. So he will only be paying the 19.5% tax on that because the company's already paid on his behalf. Similar to PAYG withholding when you get a wage. Your employer pays the tax on your behalf and you act as a benefit for you in your tax return. That's essentially what a credit is. So when a company pays its taxes, so it could be normal income tax, PAYG installments, not PAYG withholding, but income tax installments, and any dividend that it might receive, it gets credits. And it goes into an account that you'll see in a tax return. And if they don't use those credits, it can get built up for multiple years, and they can decide to pay a massive dividend at that point. So it's a running balance from the moment the company pays tax.
Okay. And just because I missed KM's voice, I wanted to ask him, when you see a lot of your customers coming through, like investors, have they seen their accountants? Because that's something obviously Mark and I obviously tell a lot of our customers that are coming through and they're about to start a portfolio, they're looking at strategy or anything like that. Are you seeing these days investors coming through and they've already done this research, they've already sat down with their accountant, obviously they've sat down with their broker because that's, they come to you with a pre-approval. Do you with your investors that have like multiple properties in their portfolio, is this something that they've sat down and done? Do you see a lot of the company trust, they're purchasing through trust or through companies?
We typically first-time investors have not usually spoken to an accountant or gone into depth regarding their structure and what the best structure is for them. Typically, probably 90% or more of the time, they're coming and buying in their individual name and have not had that discussion. After that one, most people that have multiple properties that we speak to have by then have had a conversation with their accountant about what's the best structure for them. And sometimes, it gets a little bit messy because they haven't had the conversation from the start. But most people that we see with multiple properties are, sophisticated investors, they've purchased a few and they're trying to find the best structures to continually be able to borrow, opening different trusts so that they're not capped from a borrowing perspective and whatnot. We find those guys have definitely, but first-time investors, more often than not, 9 out of 10 times have not had a conversation with their accountant or have had a very general, brief conversation with an accountant that's not investment savvy, just a general accountant who's, giving tax advice and saying, yeah, buy under your name, that's fine, and not actually discussing with the client what their long-term goals are. And because obviously, if you're buying one property, it's sort of irrelevant what structure it's in, right? But if it's, if you've got an idea of building a portfolio of 5, 10 properties, or, you want to continue to expand your portfolio, obviously the structures are very, very important because it can enable you to buy more or can stop you from buying if you do it incorrectly.
And is that because you're seeing a lot of customers come in, like, for example, they're buying the individual name? I think there's a discussion that, we've had before in the past where they hit that ceiling in regards to their borrowing power, especially if they're either on interest-only loans. Obviously, if they're purchasing, like from what Bish was saying now, obviously they're purchasing under a company or under a trust, they're getting those benefits where they have more of a structure where they have a few properties under individual names and a few properties in their trust to allow them to continually expand, which Mark and I have also seen with, a few of our customers where they're allowed to be able to, from that separate entity, purchase investment properties through there, and a few they can in the individual names.
Yeah, I mean, definitely. I think the guys, like especially the first time investors and whatnot, it can it's a very overwhelming process, right? Buying property, especially if you've never done it before. So, once you start talking about different trust structures and, who's going to be the director and the beneficiary, and it gets a bit complicated. Buying in your individual name is very, very straightforward, right? So most first-time investors just do that. Whereas once you start to accumulate and then you realize, okay, this is how you want to create wealth. And then you speak to your broker and, you guys tell them, oh, you can't borrow any more money, whatever, because of DTI or whatever it is. They say, okay, what's the solution? And then that's when the accountants sometimes get involved, or when the client goes to see their accountant, which is probably the wrong way to do it. You really should be speaking to your accountant from the get-go to really get the best structures in place from the start, having a conversation and saying, hey, Bishoy, I plan on building a portfolio, 5 properties, 10 properties, who knows? I just want to accumulate. What's the best way to do so? I think it's just more of a simplicity thing where people are just buying in their individual name at the start, because there are so many things going on in buying a property. And that's why it's so important. We always say it's so important to surround yourself with a team of professionals that do this day in, day out. Your accountant, your broker, your buyer's agent, your solicitors, your conveyancers, to make sure that every part of the process is taken care of. Because more often than not, this is the most expensive thing anyone usually ever buys in their lifetime. So you really want to get it right. We don't typically see, I don't know, Bishoy, from your perspective, but I don't typically get a lot of clients buying in companies. It's usually trusts or an individual name.
Yeah, look, when you get a person that's purchasing a property in a company, it's mainly because of whether they're in, again, different industries apply different approaches. But if you're a builder and you're a developer of some sort, building it or purchasing in a company has its benefits, because that company can also, if you're a builder, can also be the developer or the builder of the plan. So you might decide to buy a rundown property and build a duplex, for example, or units or whatever. So there's a benefit there from one, obviously from a tax perspective, but two, from a legal perspective as well. When you're building and doing a development of that nature, there's a lot of risk. There's a lot of risk from a bank's perspective, from even OH&S, all these risks there. So doing it in a company structure has its pros on that perspective. So yes, I agree with you. Not many, let's say your day-to-day Joes, they don't go walking into their account or speaking to me or going to their account and saying, let's buy in a company. Because buying in a company, and I think we'll touch on soon, I do recall me and Mike were speaking earlier before this starting, but CGT, capital gains, where we'll touch on a bit later. Buying in a company's name is not always a benefit. Sometimes if you're the lesser of two evils is usually a better option to go with, depending again on what your long-term goal is. So if you're not looking to sell that property and you're looking to build on it, well, the company is not too bad. If you're looking to sell soon, then there's other options that are better.
I just have a question. If you go back to, I think, the first question regarding the positive, cash flow implications of buying in a trust, and obviously being able to flush those profits through to different, to different people, and distribute those funds. I have a question on the other side. If there is a negative cash flow implication to a purchase, to a property, I believe I know the answer, but I could be wrong. Can you? I don't think so, but can you distribute losses as well, or only profits?
So no, you can't. So rule of thumb is, in a trust, you can only distribute profits, whether it's revenue profits or capital profits. It's profits. You can't distribute losses. That falls under what we like to call future losses. So you can apply it in the next year if you make a profit, but in that year you can't go, oh, I'm going to distribute that to Fadi or Mark or KM. You have to apply it in the entity, in the trust next year if there's a profit. So it still has its benefits, but it's a later on benefit.
So you can leave a negative amount in the trust. So the financial year it's left in a negative. That doesn't really help. It doesn't really affect anything at all. There just won't be any distributions that year and no tax paid by the customer. So it just be left in that state until the following year. If there is a profit, that's when they can.
Yeah, that's right. So whereas in an individual's name, that loss gets applied in that year. So if the same thing as an expense, it acts like a deduction. So if it's negatively geared, in that year, that financial year, you can claim that. So if your income in that year is quite high, well, you'd rather be able to claim it in that year as opposed to waiting later on. So again, there's pros and cons on both sides. But yes, to answer your question, Cam, in a trust, you can't distribute any losses.
So just to clarify that and to like give an example, say there is a trust and we ask for the beneficiaries of this trust, and the trust made an $8,000 profit for the year through cash flow. We could distribute that $2,000 each, $6,000 there, 1,000, whatever. If the trust had lost $10,000, we can't then send minus 2,000 to Mark, minus 2,000 to Fadi. It just sits there. But the following year, if the trust made a profit of 10,000 or say a profit of 20,000, we could then take off that 10,000 and say, okay, it's only 10,000 there. Is that correct?
That's correct. Yeah, that's correct.
Cool.
Just wanted to ask, so we were talking before how important it is and why some people don't talk about structure beforehand. I think one other reason is because a lot of the time with first-time investors, they get very excited to start. And when you tell them, oh, you need to go talk to your accountant, it might take a week or two to set up, to open everything up and to get all the trust deeds and everything drawn up. Automatically, they're like in their head, automatically that's no longer an option. A lot of the time after the purchase, they then ask, can we now move it to a trust or company? So I guess my question is, do they have to pay stamp duty again to move the property from their individual name to their company or trust?
Yes, yeah. So it's because it's the same way as you. It's a separate legal entity. So in the eyes of the state and federal government, it's a separate legal entity. So if you're transferring it the same way, if you're transferring it to a partner, that percentage would be revalued and there'll be stamp duty on that amount.
The government won't let that go, man. You pay.
No, they won't. Stamp duty is it's a strange one, but I won't get involved. I won't say my spiel now. I might get in trouble, so I'll stay quiet. But, yeah, I don't agree with stamp duty. I never have.
Perfect. So
Yeah. Just on trust being a separate legal entity, right? Is there a, I'm just trying to phrase the question. Is there a benefit if I buy a property, if I have a trust and I'm the only beneficiary, so it's just me, and I buy the property, I buy my investment property in that trust as opposed to my own individual name. My understanding is that the benefit there is that there is no debt against my name, but it's against the trust. And then if I wanted to borrow more money from the bank, maybe this is a broker question, I don't know, whoever wants to answer. My question is it more beneficial to own properties in a trust? And then if that trust was to get, maxed out, could you just open another trust and then continue to borrow against that? I don't know who's going to answer that, but
I'll let the boys answer that one. My fine gentlemen.
So in regards to that question, when it comes down to the purchasing within the trust, I lost train of thought. What was the question at the end?
Can you just start opening up another trust if you?
Yeah, can you just continue? Yeah.
If you keep it opening. So, okay. So, for example, when I lodged a deal similar to that, where they've now started purchasing within the as an individual name because they believe their trust is gone to the max, the banks are still going to ask the question. We have to still notify the bank they do have a trust. These are the sort of debts underneath it. The banks are going to ask a simple question: are the trust, servicing itself? Is it coming at a loss? And they want to provide an accountant's letter of that. So if you go open another trust, I don't think it would work because they're going to still see the outstanding debt there unless the new trust can actually service itself.
Okay.
And I don't see anyone really moving on to a second trust because it's always going to come down to, is it going to be able to be self-sufficient?
But if the first trust is self-sufficient,
yeah,
and you get that accountant's letter saying it is self-sufficient, then yeah, opening up another trust, maxing that one out, and then rinse and repeat. If all trusts are positive in cash flow at the end of the financial year, then yeah, it would work.
But why are you opening up a new trust?
Yeah, I was
You
going
max
to
out the first one. You can't borrow any more in the first one.
Yeah, but it's going to be the same situation in the second one. If this first one is self-sufficient and it's servicing itself, I don't see why the banks won't lend out. There's no reason to open another trust. The same rules and implications are still going to apply.
But if all the loans in in the first trust are stopping you from getting another trust, and we get that accountant's letter saying that it is self-sufficient, and we sort of shut that trust off, open up another one, use our PAYG income with no personal debts on us to open up and purchase in the second trust. Wouldn't that work?
To use your PAYG income within another
Yeah.
trust.
Yeah.
We're not using PAYG income. That defeats the purpose of opening the trust. So it doesn't affect your PAYG income. It's your individual.
I guess my question then becomes, is there a benefit from a serviceability perspective of opening a trust? Or is it,
Yes.
because
Definitely.
if, for example, because the whole self-sufficient thing, right, this is where I'm a bit confused, is, okay, if I have purchased property under my own name,
Yep.
and it is all positively geared and it's all self-sufficient, why would the bank firstly not lend me more money? Because clearly I can pay for it, I can service. If I got to a point where I couldn't service, when I open the trust, if they're still going to look at that debt, where is the benefit?
So in the individual name, keep in mind, like, you can service the loan, but in regards to the banks, there's always going to be that buffer rate or the assessment rate. They're going to be charging a higher one. So if you're saying you've maxed yourself out in the individual, but you still want to purchase within a trust, as long as you're purchasing in that trust and it's self-efficient, it's going to be covering itself. Like an SMSF, we have contributions going in or the rental income going in. As long as it's self-efficient, you're still able to do so. So when you're purchasing from a trust, the best benefit from there is, for example, let's say I have a trust and I've got 3 properties in there and it's self-efficient. I'm still able to go out there and buy a property within my individual name, and those outstanding debts are not going to affect my serviceability at all, as long as it's self-efficient. But if you're going to come back and the bank's going to say, is that trust self-efficient? Is there any income going from the individual's income into that trust? That's where it's going to affect you.
Okay, but the total debt is always assessed.
Yeah.
It's not like they ignore
They don't
debt.
ignore it. You have to notify the bank of what's the outstanding debts, and as long as those other outstanding debts within the trust are servicing themselves, it's not going to affect you.
Okay, so if the trust is self-sufficient, then the bank will continue to lend you.
Yep.
Same thing. So you wouldn't need to open another.
If at the end of the financial year it makes $1 profit, that means you've paid all the outstanding debts in that trust and you still walked away for $1 profit. It does not affect you.
And the bank would allow you to borrow more against it?
Yes.
Okay.
Within the trust. That's what I'm saying. There's no point of opening that second trust.
There's no point of buying property under your own name either, I guess.
Yeah.
By the sounds of it. Bishoy, jump in before I start getting in trouble.
No,
that's my fault.
There's
That's
pros
my
and cons, I
fault.
feel like, with everyone.
Yeah.
Sorry?
There's pros and cons for there's pros and cons for all 3 setups, whether it's a company, a trust, or individual. It comes down to what you guys were saying earlier, which is once you have a discussion with the client, what's their ultimate goal? What's their 3 to 5, their 5 to 10-year goal? Now, if they're there to buy the one property, well, the cost of setting it all up and going through that process wouldn't be worth it. But if they're looking to develop and get the builder's license and do all these other things, well, then a company has its benefits. If they're looking to get multiple properties and help their kids out as a guarantor, a trust or an individual, because I think Fadi might be able to, or Mike, they might be adding to it, but you might sometimes be able to use trust distributions for serviceability if they get it regularly or something, from my understanding.
Yep. So let's say that $1 you made that year, you can add it to your income, but if you made a loss of $1, you take it out of your PAYG income. So that's how the banks will assess it. So they want to know, it's not going to affect you, but they want to know what's outstanding there and if it's affecting your individual income. That's the most important part, because we're going to be borrowing under individual name with your full individual income.
Yeah.
And given this market, the bank is going to be asking those questions.
Yeah.
Okay. I'll go back to you, Mark.
I was going to say, let's move on to capital gains tax. So I'll tell you what I sort of think is the case, and then sort of correct me because I'm sure it's wrong. So if someone purchases a property under their personal name, hold it for more than 1 year, however long that is, sells it, makes 200 grand profit, that 200 grand is added to their individual income for that financial year, and they pay income tax on it. Is that correct? If it's in their individual name.
Yes. So if you buy a property, so if you buy a property in your own name, let's say you sell it for $1 million, right? I'm talking gain, and you hold it for longer than 12 months. You would half it at 50%. So 500,000 of that will be taxed at your tax bracket, which generally is at the higher tax bracket. However, there's always an however in accounting. However, If you buy a property pre-1985, so before CGT rules came out, it's not taxed. So you could sell it for $3 million and you will not be taxed. So for those like us, when I speak for myself, I wasn't born in 1985. So, and if I was, I would probably be young. So I didn't purchase a property in that time. It wouldn't apply to me. So I'd have to look at that. But yes,
My parents came in '89, so we missed out.
Yeah.
That makes sense. So the 500 grand, which is half of the gain, because you owned it for more than a year, is added to your individual income for that financial year, and you pay income tax on it. Okay, so now if we look at in a company, if you sell the asset, also after owning it for 1 year, is there any benefit for holding it or selling it in under 1 year or more than 1 year in a company?
Unfortunately, no. So companies actually get nothing. They, in this sort of circumstance, you look at CGT, the ITAA, which is the Income Tax Assessment Act, pretty much says the discount capital gain can only apply to an individual, super fund, a trust. Those are the three entities that applies to. A company, the basic rule is doesn't get it. Now, if it's in the business of running, like if it has multiple properties and doing the multiple things, then obviously you can argue that the carrying on a business, and you have to apply that. There's other concessions that would apply for them. But the basic rule, if they've got that one property in the company, no, they wouldn't get a discount if they sell it. So it'll be taxed at that full amount at 30%.
Okay. So they can potentially see with their accountant, they can pay themselves a part of that as a dividend, pay income tax on that, retain some in the profit, pay company tax on that. Is that sort of correct as well?
Yeah, so what will happen is, let's use that initial example of they made $1 million gain, gain on the property. In the company name will get taxed at 30%. So 300,000 will be the tax on that, and that will be sitting in what we like that franking account that we're talking about. Now, if they choose to pay a dividend that year, that 300,000, depending how much again they take out, can be used as credits to go against their own personal name. They want to take that money out of the company, or they can do it further on later on, next year and the year after. But the amount that they paid in the company as tax will be used to help them out if they do want to pay it, depending on the shareholding that the shareholders are.
And I'm guessing if in a company, if you've got making that, let's say making a $200,000 profit off a property, they're going to reuse those funds before tax period time into a new let's say it's for a builder, they can reuse those funds into a new project before financial year end. So they're not really showing a 200K profit because those funds are now being used. Can that be done, or?
Unfortunately, no, because now it comes back, it depends, right? So if they're in the business, carrying on a business of developing and selling, then it would come under what we like to call the revenue account. So there's two sort of areas. There's a capital, and then there's revenue. The revenue, so if they're in the business of running and building developments and selling them, you can argue they're carrying on a business. They'll be paying GST, they'll be doing all these requirements. At that point, yes, any expenses relating will be claimed as a revenue, and it will be assessed revenue, like on the revenue side. On the capital account, it's different. So if they go make a $500,000 gain and they go purchase a property with that money, they're still going to get taxed on that $500,000. They're still going to have to pay that $500,000, regardless if they use that money to go buy another property. They still be paying because it's a separate event. It's a separate CGT event. So you have to, again, I'm always going to say this as a disclaimer, always speak to your, talk to all listeners, speak to your accountant. But if you're just buying one or two properties, it'd be very hard to show your intention is carrying on a business. So in that situation, you would have to pay the tax regardless that year.
No escape.
Yeah. And I was just going to say, so we went through CGT in an individual name company. And so for a trust, is it just that the capital gain, whatever it is, flows through, like the trustees decide who's going to get what, but it has to be 100% of that gain has to be distributed every financial year. And then when the individuals or companies or whatever it is that receives their share, their tax implications based on their structure occurs. Is that also correct?
Yeah. So in a trust situation, the trust doesn't pay tax. If it, as long as it distributes its profits, it doesn't pay tax. So in this situation, this gain would have to be distributed to its beneficiaries. Now, the beneficiaries can be whoever. You can distribute a certain split. It doesn't have to be the one person getting all. And then the CGT discount will apply in their name as if they were the earner of that property. So they'll still get a 12-month discount. That's like the 50% discount on holding it for more than 12 months.
Okay, I didn't know that. All right.
Sorry, can you just clarify that? Is the CGT discount, the 50% discount, is that applied before distributing the profits or after it's been distributed?
So the way it works is the end result is gets applied in both. But what happens is in the tax return of the trust, it will be a net gain, so net capital gain. So it'll be applied prior. Then when it goes into your individual name, you have to gross it up. So back to what it was as normal. So let's say in this case, the 500,000 would be a gain of $1 million. And then you would apply, because in your own personal name, you might have capital losses. You might have things from previously that you can apply in that to reduce it. Once you apply all those other concessions, whether it's capital losses and all that, then you then apply the 50% discount on that amount. Yeah. So it does happen, but it just depends on what's in your personal name as well.
Yeah, for sure.
Kane, were you going to say something?
No, go ahead.
No, I was just going to say the final, but it's like I'm moving on to the next one. So if you have anything, jump in.
Oh, good.
That's like the final.
So just the final thing as well was just obviously every accountant's going to charge something different. But just in general, what's roughly the range that an individual should be expecting to pay to open up a trust as opposed to...
Again, I'm always going to say there's always sides, but if you have a trust and you have, so like I said, you have a trust and then you have individuals as a trustee, it's cheaper. So if you have yourself as the trustee of the trust, then the cost is around about $2,000 to $2,500.
Okay.
Could go up to $3,000. If you have the trust and what we like to call a corporate trustee, which is a company is essentially the trustee of the trust, which is generally what you would be doing. The cost is about $3,000 to $3,500, sometimes $4,000, depending on which state as well. Because some states have stamp duty when you set up a trust, some states don't.
Yeah.
So there's a separate $500 cost, as if you're buying a property or something. There's stamp duty that gets paid automatically. That's not a part of the accountant's cost, generally.
Yeah.
It gets passed on to the taxpayer or the client. So you're looking at about, for a basic trust with just individual trustees, you're looking at about, 2 to 3, and anything between 3 to 4 for a trust with a corporate trustee.
Okay.
And maintenance cost on that?
What was that?
Is there a maintenance cost as well?
Yeah, well, you beat me to the gun, Kane. You beat me to the gun. But to maintain the trust, there's obviously a tax return you'll need to do, and that obviously is based on how many properties you have, the work required. You'd probably speak to your accountant on what they charge generally for a trust tax return. But you'll be doing the tax return. You may need to do quarterly bases, depending, which is business activity statements, depending on what's in the trust. There's also trust minutes that you do every year to determine who will get that money. So before the end of the financial year, you would speak to your accountant saying, hey, we anticipate there's going to be an income. Who we want to distribute it to the following people. And then the accountant would apply that in that tax year. So there's a cost of preparing that. So there are costs, and they're all very dependent on, obviously, the work involved, how many properties you have in it. But I would speak to your accountant. But those will be your costs that you'll be sort of looking at, which will be the ongoing costs are the tax return, potential bases, which are business activity statements, the trust minutes.
And when do those bases have to be lodged? Is it if you make over a certain amount, or how do they sort of do that?
Well, it comes down to if you're earning more than 75,000, you will need to be doing it. But in saying that, if you're running a business and you're a developer and you're looking to develop and all that, you would need to register for GST initially, because that will be a requirement. So it just depends. So most of the time, depending on the property, if you have one or two, if it's very positively geared and there's not a big loan, you might be able to earn around that 75K mark on the one property or two. But if you're not, rule of thumb is you generally wouldn't do BASs, business activity statements for your trust, because it's not really carrying on a business.
Yeah. Okay. And what's the cost with starting up a company as well as the maintenance of it as well? generally?
So setting up a company, again, it depends on the shareholding. So if you have a company with yourselves as a shareholders, like individuals, that cost is around about $1.5 to $2 as well. But if you have a company with a trust being the shareholder, that's a separate cost. That's obviously an increase. And that, again, you're looking at about that $3K mark for that.
Okay.
And again, there's obviously ongoing costs similar to with the trust or maintaining it, which is obviously the tax return. And in this case, dividend statements, if you're doing dividend statements in that year. So there's a cost there as well.
Right. Okay. Well, that's pretty much all my questions. Just wanted to go through land tax, CGT, and the general costs, which I think we've done. You guys have any other questions?
I'm just going to ask, does a trust expire? If I set up a trust today and don't use it for the next 10 years, does it expire?
But the word for it is, does it vest? And it depends on the trust deed. So generally it's 40 years that it will be vested, but it depends on the trust deed. The trust deed will be able to provide you, it is, I believe recently they've gone up to 80-year trusts, but there are trusts back in the days that were done prior in the 1990s that could be less. So it's always important to revise your trust deed to see what it says.
Okay. Can you just, if we could just do a real quick summary, maybe one major benefit and one major negative of purchasing a property in your individual name, trust, and a company, just to kind of wrap up and summarize?
Yeah, well, from your individual name, the benefit is you have the CGT discount. The disadvantage is, and you also, another advantage is you have the land tax threshold. The
It's cheap to set up.
you don't have that. What was that?
And there's no setup cost.
And there's still ongoing costs. There would be an ongoing cost, but yes, there's no setup cost. Yes, correct. The disadvantage is the flexibility. You don't have that flexibility to work with. So you might end up saving yourself a couple of $1,000s here and there in the short term, but the amount of tax you paid on what you're trying to achieve is a bit more. In the trust perspective, the benefit is obviously you have that flexibility. The benefit also is you have the land tax threshold. Oh no, you don't have the land tax. Sorry, let me take that back. I'm confused myself here. In the trust, you have the benefit of the flexibility. The disadvantage is you don't have the land tax threshold, and the cost is quite higher than it would be in an individual's name. And the other benefit is obviously, touching on what Mark was saying earlier, is the CGT discount does apply to that. In a company's perspective, the advantage is it gets taxed at a bracket of 30% max. But in saying that, depending on how to take that money out from the company, if you want to use that money, there are obviously disadvantages there, and you'd have to speak to the accountant. The disadvantage, unfortunately, is there's no such thing as CGT discount. But the other advantage is, similar to an individual, there is a land tax threshold.
Yeah, beautiful. No other questions, boys? To be honest, I didn't think you'd be able to step up and follow up last week's show, but you did.
Look, I watched it, and it was quite intuitive. It's very. I don't think I could have either. So I think last week's
you've done a very good job.
I'm very surprised. Well done.
Yeah.
No, I appreciate it.
We can have another episode where we can just discuss SMSFs as well, because that's another big one.
Yeah.
But yeah, we can do that later on.
Yeah, I'm always available for you fine gentlemen. So on a side note, non-obviously finance, property, accounting related, who you guys got for State of Origin tonight?
No idea.
Madrid.
I like Madrid.
Melbourne.
Well, I'm taking that question because we're all from Sydney. We're going to go for New South Wales.
Victoria.
There you go. Yeah. I get that.
I couldn't tell you that. I didn't even know Origin was on tonight.
I didn't know that was still on. The whole sport was still on.
More importantly, Australia beat UAE last night 2-1. So they played Peru, hopefully to the World Cup. But no one that's listening to this actually cares about that. So anyway.
Anyways, completely off topic. Yeah.
No, well, thank you very much, Bish, for coming on. We took a lot of your time, so thank you. No, it was it was a very good episode. I'm sure this will help a lot of people. And yeah, like Fadi said, whenever you're free, we'll get you on again. We'll do some SMSF stuff, and we'll find harder questions because obviously these are too easy for you. So your big general disclaimer: everything that was discussed, obviously, is just general opinions and whatnot. It's not advice. Definitely, every situation is individual. So speak to your accountant individually, and don't take what Bishoy said from today and try and sue him later. You will not succeed. All right, thanks, boys. Take care. Have a good night, and go Victoria.
Thanks, boys. I appreciate it. See you later.
Yeah.